Hey viewers, you might be excited that how these banks came into existence. So, stick till the end with high story to explore it. The idea of a bank initially emerged when empires required a mechanism to pay for foreign products and services, which may have been as early as 1800 BC. Banking has existed since the creation of the first currencies. They needed something simpler to exchange than, say, 3 pigs and a cow as payment. This gave rise to coins, which were made of different metals like silver and copper and were universally acknowledged to have a particular worth. These coins, however, had to be kept in a secure location. Obviously, there were no fireproof safes in ancient dwellings. Since everyone trusted priests and other temple employees to be pious and honest, most wealthy people kept their monies in the neighborhood temples, which also added to a sense of security. Greek historical documents of Rome, Egypt, and ancient Babylon imply that the temple did more than just protect the money, it also lent it out. Rich people who kept their money in the temples would lend it to the needy while charging a little amount of interest because coins are simpler and more practical to hoard than, say, donkeys and horses. Temples were frequently looted during conflicts since they were also used as financial hubs. The Romans were the first to institutionalize banking by relocating it from temples to specified buildings and then giving the banks full legal backing. Early on, the law was undoubtedly on the lender's side, regarding failure to pay debts as a crime. Upon failure to pay debts, Julius Caesar granted banks the authority to confiscate the land and possessions of citizens. This implementation, along with other legal authorities, was crucial in enabling banks as institutions to become safe and successful. Bills of exchange were developed to avoid lugging cash and heavy treasure chests about as commerce grew as money changers at merchants produced documents redeemable at other merchants in return for actual currency. During the period, banking mostly consisted of two types: private banking for the wealthy and commercial banking for trade. With local and international finance available for trade, both businesses and those who controlled finance substantially flourished. When it comes to modern banking, which was made available to regular people's homes, it has come a long way from the temples of antiquity. However, their fundamental business principles and purposes for existing remain the same. They offer safety and security through responsibility and trust. With the advent of credit cards over the past 50 years, client interactions with banks have undergone a rapid change. ATMs, mobile banking, and loans that appear to be approved for everyone right away in developed nations, having a bank account is almost required for people. With the emergence of cryptocurrencies and the rapid advancement of technology, the future of banking is still uncertain. We are starting to understand how common households might safely save their money without the requirement for accountability or trust. We've seen throughout the most recent technological revolution that people can put up collateral to acquire loans without using any banks. The fundamental issue of trust, which underpins the functioning of money and national currencies, is resolved by blockchain. You believe that this $20 bill is worth $20 because the government says so, yet if a nation eventually falls apart like the Roman Empire, this $20 bill will become a worthless scrap of paper. Just look at the Venezuelan bolivar to see how users may evaluate the worth of a cryptocurrency like Bitcoin without the requirement for trust. We hope you enjoyed this video. For such intriguing content, subscribe the channel.